Intel stock is down over 11% after reporting its Q2 earnings. They missed expectations across the board by a lot. Non-GAAP earnings per share came in at 29 cents, falling short of the already down analyst projections of 70 cents. Revenue came in at $15.32 billion, down from the analyst estimate of $17.92 billion. On top of this, they slashed their full-year guidance for earnings and revenue. When you dive deeper into the report, there is not much positive. Intel's Q2 was ugly, really ugly. Yet on their earnings call, Intel CEO Pat Gelsinger was positive about their long-term business outlook.
I'm ugly and I'm proud.
Louder!
I'm ugly and I'm proud.
Louder!
I'm ugly and I'm proud. I am ugly and I'm proud. I'm ugly and I'm proud.
Is that what he calls it?
Intel's Q2 earnings bring in new questions for investors. Is the management actually capable of executing their planned business transformation? Will they lose too much market share to competitors? Can they actually fund their massive expansion? And is the dividend safe for investors? I will discuss all this in today's video. Aside from the negativity in the report, there was actually one very positive piece of news for Intel. Around the same time as the earnings release, the much anticipated CHIPS Act was finally passed. This would provide tax breaks to help semiconductor companies like Intel build fabrication plants in the US. More on that later. In this video, I'm going to dive into Intel's latest earnings report, provide updated insights from their CEO, share commentary from various semiconductor stock analysts, and in the end, explain whether this impacts my Intel investment thesis.
This symbol outside means you have the standard inside that an entire library of software has been written to. The Intel microprocessor. Think of it as a library card that lets you run the software of today and tomorrow. So check out Computers with Intel, the computer inside.
My name is Zach, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout this analysis, I will occasionally be using my research software available at dividenddata.com. Check it out and sign up with a 30-day money-back guarantee. Let's dive into the earnings report. Revenue is down 22% year over year. Gross margin is down over 20%, from 57% to 36.5%. This is an insane drop. If we look historically, this is their lowest quarterly gross margin in decades. Expenses are up 17% year over year. Net income for the quarter went negative. GAAP EPS went negative. This was a disaster. If we look at the revenue of their business units, we can get a little more detail. Client Computing Group, which is their desktop and notebook CPUs, revenue was down 25%. The Data Center and AI Group was down 16%. Network and Edge Group was up 11%. Their other businesses were mixed, but not yet notable enough towards the overall pie. They declined across their two core profit centers: consumer-oriented client computing and enterprise-focused data center. This is not a good sign. PCs have shown weak demand year over year. It seems Intel and other semiconductor companies have oversold in previous quarters. Now demand is slowing down and they have oversupply, lowering their margins. Strong competition could also be a factor, but AMD and Nvidia have yet to report earnings. It should be noted that TSMC, the other largest chip manufacturer, did report earnings and they were quite good, beating expectations. Let's see what Intel CEO Pat Gelsinger had to say on their earnings call.
While we continue to make solid progress on our strategy, Q2 results were disappointing, below the standards we have set for the company and below the commitments we have made to you, our shareholders. The sudden and rapid decline in economic activity was the largest driver of the shortfall, but Q2 also reflected our own execution issues in areas like product design, DCAI, and the ramp of AXG offerings. We have an obligation to remain vigilant and to respond to the changing business conditions while not losing sight of our long-term goals and opportunities. We will look to do both by adjusting and refocusing our spending levels in the near term at the same time as we accelerate the deployment of our smart capital strategy and improve product execution. Collectively, these actions will begin to show dividends in the second half of the year, allowing us to return gross margins to our target range by Q4 and maintain our initial free cash flow outlook for 2022.
Pat blames both the macroeconomic conditions and their poor execution on the Q2 results. They are committed to improving performance, lowering expenses, and returning gross margins to their target range by Q4. On top of this, they did not lower their free cash flow guidance for the full year. Keep in mind this was expected to be low because of their massive investments in building more fabrication plants. Now let's listen to him explain whether the dividend is safe and how this is impacting their long-term strategy.
Importantly, Expense discipline is not impacting the strategy, and we remain firmly on track to achieve process performance parity in 2024 and unquestioned leadership in 2025. This goal is our true North Star. Second, our ability to invest aggressively and fulfill our commitment to a strong and growing dividend is anchored by the progress we are making in deploying our smart capital strategy. We are thrilled to see the bipartisan vote in the Congress this week and expect CHIPS Act to be on the President's desk shortly. This progress, combined with the strong momentum in Europe, will reshape our industry and bring us toward a geographically balanced, resilient supply chain that we are uniquely positioned to enable and benefit from.
Pat reassured that the dividend is safe and they are committed to a growing dividend over the long term. This is great to hear for us dividend-focused investors. Additionally, Pat stated that they are on track for process parity with other manufacturers by 2024 and leading by 2025. This is ambitious, but it's good to hear that they are still confident. Pat was just on CNBC to discuss the quarter. This is what he had to say.
Pat, good to see you. Boy, ugly quarter, and I want to understand better what you see in it and beyond it. So first, dealing with PC demand overall and your confidence heading into, I'm going to jump way ahead even to Q4. You're drawing down inventory, but you're also expecting to raise prices in Q4. What gives you the confidence that you can do both at the same time and that inventory drawdown is going to happen at the rate that you need, even as demand continues to be soft?
Yeah, thanks, John. And yesterday was a incredibly good day with the CHIPS Act passage, but also a tough day with the earnings update. And clearly, we didn't meet our expectations nor our shareholders' expectations. Part of that was driven, of course, by the acute economic swing that we saw, but part of it was our own execution, and we're owning up to that as well. On the PC side, as you start with, what we were clearly ahead of the market on our expectations, and literally, we've been years of catching up to demand, and with this sharp economic swing, all of a sudden we got hit two ways there. One was, the decline in the consumption rate, but the other was an immediate shift on the part of our OEMs and channel to adjust inventory. And everybody was carrying too much inventory just because of match sets, expanding the demand requirements and the difficulties of supply. So at this point, part of what gives us confidence in the second half and into next year is our consumption rate is now below that of the end user. So we're clearly drawing down a supply, and there's going to be a natural bounce back as we go into the second half of a stronger year. Also, the changes were primarily driven on the consumer side, John, and the strength of enterprise where we have higher market share, higher ASPs. We continue to see that. And, also we now have 600 million PCs that are over 4 years old. And the usage of the PC in the post-pandemic world remains extremely high. That we've adjusted our outlook now. We took about 10% out of our forecast for the market, but it's still comfortably above 300 million units. Before we were above the market. Now we're right aligned with the market in our forecast, 310 to 325 million PCs. We don't see that changing with the replacement rate, the usage rates as we go into next year. But now we're right in the middle of the pack. The range that we gave is consistent with those market characteristics. And finally, I'd say, John, is we have our best PC product line in at least 5 years. Alder Lake, we're now ramping Meteor Lake to our customers. Soon, Raptor Lake next year, a Meteor Lake, a very strong product line. So we also see ourselves as a share gainer, even as we go through some turbulence in the marketplace. So overall, we're very confident. And as we said on the call yesterday, this is the bottom. We're rebuilding from here.
It seems like Intel was ramping up supply, anticipating growth, instead being met by drawbacks in demand. They are now readjusting supply to meet the current economic environment. Pat seems to be confident in their long-term plan and upcoming product releases, even saying they expect to gain market share in some areas. Additionally, he firmly stated that this is the bottom and they will be rebuilding from here. That said, Wall Street is anything but confident. The stock is down over 10% and Intel is getting trashed on basically every financial outlet.
You talk about a host of issues that this company has been dealing with too. Lack of or losing market share. I should say, right into a PC slowdown caused by these same headwinds in the macro environment that we've all been talking about. And oh, by the way, as the company is trying to transform itself, which the CEO, Pat Gelsinger, has made awfully clear over the last many months since he took the helm of that company. You wouldn't own this, I don't think, for anything now, would you?
No, I mean, I think Intel is frozen in time. And I think that's the issue. And if you look back 5 years, Intel, I think over the last 5 years is up around 12%. It's up $5 in 5 years versus NVIDIA is up about 300%. AMD's up even more than that. And that just shows you they just missed two big important cycles. And I think Pat is coming in obviously very brilliant. They're going to have to spend so much money. And so I continue to think that even though you have a nice yield from a dividend, this is a value. This is not a value. This is a value trap, not a good value.
This is a horror show in terms of earnings. And I think, look, Pat's not a superhero because especially if you look at the PC exposure, remember Microsoft Cloud was the pillar of strength. PC we're seeing from our Asia checks continue to be weak across the board. Just like she was talking about, I really do believe AMD and NVIDIA, much better position. It's going to be an Everest-like uphill battle for Intel over the coming years.
Lots of negativity over there. Now I'm going to share some commentary from two semiconductor analysts to provide more insight into the Intel situation. We'll discuss the recent quarter, competitive environment, and thoughts on their expansion into the foundry business similar to TSMC. Afterward, I'm going to explain how all this impacts my investment thesis for Intel stock.
People knew it was going to be bad. I mean, the company has been publicly sort of talking down numbers, but I don't think people thought it was going to be this bad. This is an ugly, ugly print. PCs are weak. We knew that, but I'd say in their numbers, it's much worse than I think people would have thought, given even the weakness we're seeing in that market. My guess is they're probably dealing with channel inventories as well as weak demand. Data center looks absolutely horrendous. And this is the thing that's really getting me beyond just PCs are weak. Data center revenues were down 16% year over year. They missed consensus by like $1.5 billion. The operating profit in data center was down 90% year over year. It printed a 5% operating margin. That is unheard of. The company's got gross margins now. They plunged through the 50% level. They're running in the mid 40s now. They're looking for under 50% for the full year. Like I said, ugly, ugly print. There's nothing to like here, at least in the numbers. Nothing.
Well, I mean, is this environment or execution or both?
Well, they're blaming, I guess to their credit in print, they're blaming both, and it is both. We've been of the view, at least on the PC front, that not only been over-earning in a strong market, we think they've been over-shipping, and so I think that's correcting. What I don't understand right now is that data center number, because we've had a lot of other reports from folks in like that supply chain, and people have been worried that data centers rolling over. Everybody else seems fine. This is the worst data center result that we've seen so far in the industry, and certainly the worst that I've ever seen in Intel's, at least in my history of covering the company, which was almost 15 years. I mean, they're looking for a little bit of a rebound into Q4. You can kind of back into the Q4 guidance because they gave the full year in Q3. So, I mean, they did 29 cents in Q2. The street was at almost 70. They're guiding 35 cents in Q3. The street was at 82. They're guiding about 79 cents in Q4, still below the street, but it's a rebound. So we'll have to see how that looks. And then we'll see what things look like going forward. But I think people have to remember, Intel's on a multi-year transition, a multi-year journey. It's just barely getting started. This is just the beginning of it. So I don't know what this looks like as we go forward. I think the one thing, if you were looking for any sort of silver lining, and look, people were hoping that they would kitchen sink it. So maybe this is a kitchen sink. Maybe that's the hope. But I mean, it also feels like it could be going down the drain. Like, I don't know. Like, this is, it's not so good.
I mean, this is a clunker of a quarter. I can't find any other word to describe it. Yeah. But this is as bad as it gets for Intel. They lost all the pricing power. I mean, look at the gross margin compression here. Yeah. They're really taking a hit on their pricing. So I don't think anything can, justify the kind of guidance that they have taken down here. And to me, this is, yes, execution issues, but also Intel is losing share. And they're losing share to AMD, to NVIDIA, to Qualcomm, and to TSMC on the foundry side.
Talk about the foundry side, because today we do understand the CHIPS Act has gone through. $52 billion is something that Pat Gelsinger was going to be using the money for, digging in Ohio, new fabs. But is that the right tactic right now, Mandeep?
Well, so the thing about building new fabs is it's a multi-year investment. The problem is setting up a fab, getting it up and running, having the production going will take 4 or 5 years. And a lot can transpire between now and then. And all the fabless companies that are relying on TSMC for the latest nodes, they will take share here. AMD will take share because they're using TSMC's 5 nanometer and their chips are much better right now than what Intel has on the market.
It was certainly a very bad quarter. A lot of investors doubt Intel's ability to execute its long-term strategy. There is certainly a lot of risk. However, I remain bullish on the stock over the long term. As Intel CEO Pat Gelsinger said, this is the bottom. The company is investing heavily in future growth and is focused on leading in quality. The foundry business could prove to grow into a giant over the next decade. Intel currently only manufactures its own chips, but they are investing in the capacity to manufacture chips for other companies. This is a business model similar to Taiwan Semiconductor, which manufactures chips for other designers like Nvidia, AMD, and Apple. Intel hopes that over time they can win over some of that business. Intel will find a lot of success if they can come remotely close to Taiwan Semiconductor's foundry business. On top of this, they have their own product line, which they can still grow. Demand for semiconductors is only continuing to increase over the long term as the world becomes more digitized. This is a huge tailwind for Intel. Also, there are geopolitical priorities that make Intel a more attractive manufacturer. Through the pandemic, the supply chain crisis, and the war in Ukraine, it's becoming obvious how important domestic manufacturing really is. It's a national security problem. The elephant in the room here is what will happen to business relations with Taiwan Semiconductor if China ends up invading Taiwan. Chinese chips could become the next Russian oil. So what am I doing? I'm buying the dip. Intel stock is currently trading at over a 4% dividend yield. This is a great starting yield for a company that I believe has long-term growth ahead. However, don't take my advice blindly and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use my software and join a Discord community of like-minded investors. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Please leave a comment below, and thank you for watching.